So we've had a little bit of a stock market decline or a correction. The S&P 500 down about 10% since the beginning of the month. The FTSE 350 down 4.5%, nearly 5%. It's up a little bit. But is it time to panic? Let's find out. Welcome to Destination Wealth. So the FTSE 350, which is an index I tend to like to look at as opposed to the FTSE 100, is just a broader spectrum of stocks. It's the top 350 companies in the FTSE. It includes the FTSE 100 and then the next 250 biggest companies. Now I look at this because I've got a lot of stocks that are in the FTSE 250 as opposed to the FTSE 100. Got a couple of FTSE 100 stocks, couple that are in the S&P 500 like Disney and Apple as well. But I tend to look at the FTSE 350. It just gives me a broader scope of what's going on. So as I mentioned, the FTSE 350 since about the beginning of March has been down 4.5% roughly. It's up a little bit in the last couple of days, but that's a pretty substantial drop for the top 350 companies in the UK. Not huge, but it's noticeable. As opposed to the S&P 500, which is the 500 biggest companies in the US, they've declined since the beginning of the month around 10%, which is known as a correction. Now, we're not in recession territory, that's around 20-25%, but we're in a correction. So what does this mean? Do we panic? Do we sell our stocks? Let's have a look. I'll show you what I'm doing. Now, before we go any further, I'd just like to say this is not financial advice. It's just for entertainment purposes. It's my personal story. The stocks that I'm going to show you are not designed for you to go and buy them. Do your own research, seek out a financial advisor. And if you're going to invest in individual stocks, you need to do quite a lot of research, which I go into in other videos, and I'll be going into in way more depth in future videos on how I pick those stocks and what financial ratios I tend to look at, how to read balance sheets, that sort of thing. If you don't want to do that sort of homework, then you can just stick to the indexes. Buy the S&P 500, buy the FTSE 100, ETFs, that sort of thing. And you'll do just fine. Let me know what stocks you're buying in the comments below and I'll check them out myself. So let's jump in and have a look and see what's going on. Here we can see the decline in the FTSE 350 since around the 3rd of March, where we had a top here and it's come down about 4.5%. This is where we are today, so slowly starting to creep back up again. That's a substantial decline. When we zoom out over a 10-year period, it puts things into a bit more perspective. This here is the decline that we've just looked at. This one. And it looks tiny in comparison to some of the larger ones over the last 10 years. This, you can probably guess what this is by the timestamp. This is the pandemic drop. Here we have Brexit drop. And here we have the result of the turmoil of the Ukraine-Russia war and various other factors here as well. But yeah, as you can see, this is huge. This is a massive drop during the pandemic. This is a tiny drop. It's not time to panic. Now, what puts this into a bit more perspective is how quickly, even though this is a huge drop here, how quickly the recovery was and how quick the recovery was in each of these. I mean, this feels pretty painful, this drop at the moment in the last month, because it's so rapid. But put that in comparison to these, it's tiny. Now, if we look at this, we can see it's not completely up to date. It's up to 2023, but we can see here the major drops in the FTSE 100 and how long each of those took to recover. So two of the biggest ones, three of the biggest ones really, were the Dotcom bubble burst, the global financial crisis, 2007, 2013. Brexit's a fairly big one. And then you've got the pandemic. The dot-com bubble took a bit longer. We got a fall of 52% in the FTSE 100. But it took 4 years for that to come back. Global financial crisis in 2007 took 4.5 years to recover. And that was a 48% fall. Brexit, fall of 22%, took 8 months to recover. Pandemic, a fall of 35%, took a year and 10 months to recover. That's a huge fall in the pandemic. Look how sharp that is. 35% drop. If you'd have sold out down here, coming down here, then, which a lot of people did, which is what causes even more selling and causes it to drop even more rapidly, then you would have missed out. If you'd have just waited a year and 10 months, you'd have been back where you were just by doing nothing. Now, a lot of the companies didn't pay out dividends and things in that time, so your income would have been a lot lower. But it just goes to show these massive drops, you don't just panic out of the market. In fact, if you'd have bought more down here of the stocks you held, as long as they weren't massively affected by the pandemic. I mean, everyone was affected by what happened, but there were a lot of companies that came out of that much better off than when they went in. So if you'd have bought more down here, look how much better off you'd have been. If you hadn't have bought more and you'd have just held on, a year and 10 months later, you would have been the same as where you were pre-pandemic. But imagine if you'd have bought more, you'd have been even better off during this dip here. And you had a couple of chances to buy it, all the way up, all between that 1 year and 10 months. If you'd have increased any of your holdings, which is exactly what I did, then you would have done very well indeed. The FTSE 350 drop 4.5%. It's nothing to panic about. Just hold on, buy more if you've got stock, if you've got funds available. Now, I tend to carry a fair bit of cash for events just like this. I have lots of stocks that I want to invest in, that I want to add more money in, but I just wait for the price to come to me. So I wait until the PE is favourable, the PEG is favourable. These are fundamental ratios that I'll get into in another time in other videos. But what I tend to have is I use investing.com a fair bit, and I just plug in all the stocks that I own, plus maybe some I'm looking to own. And what I like about it is it's kind of live data. So all these stocks, the majority of these, all these stocks I own in between my SIP and my ISA, some in both, some in just one or the other. What I like about this, you set up a watch list, and what it shows you is live data on the stocks. So you can look at the current days, and you can see it's changing all the time. You can see the current day and how much each of those stocks are up or down. Trading volume gives you the next earnings dates. That sort of, it's completely free, and it's constantly live. It doesn't time out, which I think is great. So you can have a quick snapshot of what's going on with the stocks that you own. But what I also tend to look at is on the fundamental data side of it, it shows you the current trailing 12-month P ratio of the stocks. I own most of these stocks, and I've got different amounts invested in each of them. So what I try to do is spread out what I'm buying so that I'm not overweight in any one or the other. And I don't look at how much I've earned in those stocks or how much they've grown. I look at how much I've initially invested of my own money. Now, it's a bit skewed because the amount I've initially invested does include reinvested dividends, which is, it's money I've reinvested, but it's money the company has paid me. So it's free money, basically. And what I tend to look at is the PE ratio to see whether they're under or overvalued. No, it's not quite as simple as that. PE ratio is relative to, it doesn't sit in a vacuum. It's relative to other companies, other sectors, and the market. So, but it does give you a quick snapshot as to whether the stock or whether the market values the stock as being over or undervalued. We can see here, now you tend to forget these in the minus figures and these that are way out of line here. But these ones in the middle here, because of this drop in the current stock market, there's a few really well-known UK companies, good UK companies that have been dragged down with this, and it makes them very attractive. So I'm looking to top up some of these. So companies like B&M, P ratio of 8.27. I tend to look at stocks to add more to when we're down under the sort of 15 P ratio, price to earnings ratio. We're looking at B&M, Associated British Foods, the owners of Primark, Ecora, Ironmart, Greggs, Shell, MS International, and Ashtead is getting quite close. Lion Trust, I'd like to see that back down, although I'm quite heavily involved in that one anyway. And Games Workshop, I'd really like to see that come back down. But you see, Games Workshop rarely drops below 20 PE. I want to add a lot more to that, but I'm waiting for that to come down a bit further. So I don't just look at this. What I'll do is I'll focus on these ones here that are in this sort of range because they're good valuation at the moment. I'll also look at my Sheets document, my Google Sheets, which is the stocks I own, the cost, now that I haven't quite filled all this in, but the stocks I own, the cost, which is the amount of money I've personally paid into each of these stocks. But again, that does include reinvested dividends, which is, yes, money I've paid in, but free money. It's worst case scenario, if you like. From top to bottom, this is the least I've paid into any one company and the most. I periodically copy the P ratio into this from this one. Obviously, it changes daily. It's constantly changing, but it's there or thereabouts. What I'll do is have a quick look just to see which of these, like B&M, Greggs, how much I've got invested. Because, yeah, I'd love to buy more B&M, but it's the one I've invested the most in. So I'm trying to spread it out more to these intermediate ones or the lower ones here, so that I'm not too overweight in any one company. What I'll tend to do is have a look at this, and we've got B&M, Associated British Foods, Ecora, and I can see that B&M pretty overweight on that, and Ecora. Associated British Foods though, 10,000 in that one, and they've got a really low PE. That's one I may have a good look at. Have a look at the chart. I'll see where there's a good entry point. And what I'll tend to do for this is I'll look at a site called Market Screener. They do try and get you to sign up and pay, so you get limited amounts of time on here each day. You can just look at it for free, but you just get loads of pop-ups. So it's best to register for a free account, so you just get a bit more time. You can look at 3 or 4 a day before it times out. So I'll generally go on here, and then we'll have a look at Associated British Foods. What I like about this is when you go to financials, if it does it on this one, it doesn't always do it on, so it depends on the size of the company. The smaller ones, it doesn't tend to show you this, but a company like Associated British Foods, on the financials page, you can see forward earnings estimates and cash flow estimates and operating profit for the next few years. Now, these are analyst estimates, so they're not set in stone, and quite often they're out, but it gives you a good idea of what the company looks like going forward, which is the important bit. If you see that these are dropping through the floor, then obviously you want to do a bit more research and see whether this is a stock that you want to be investing more money in. So you can see net sales are increasing or projected to increase over the coming years. So this is well worth looking at. look at things like debt. It is increasing, but not drastically. But there's the other thing I look at quite closely is return on equity to check that that's over 10%. Over 15 is better for me, but you don't want to see that hugely declining. Now we have got some, it's not declining, it's been increasing, and then it's got to 13, 11, and it's projected to stay steady around 11, 12% over the next coming years. So it's a pretty good website. Gives you some really good information. Say it'll time out at some point, but if you're careful of what you're looking at. So the other thing that's good here is the P ratio that I was talking about. It shows you that, again, not on every stock, depends on the size of it, but it'll show you what the projected PE is for next year. So at the current share price, if the share price stayed the same, the current PE, which was what? So if we go back to this, the current PE for ABF is 9.56. So 2025, it stands at 10.2, and then to 9 if the share price stays as it is. It shows you previous years, so you can see how this PE has dropped. 33, 31, 15, 15, 11, 10, 9, and then down to 8. So a company of this size, unless they have huge issues, which is unlikely, that share price is not going to stay down there for long. So this is definitely one that I'll be looking at adding more money into. General moral of all this is, when the stock market drops like this, don't panic. Don't panic out of the stocks that you've got, unless the only time you only sell a stock is if there's fundamentally something wrong with it, or they've got huge issues, their debt's increasing, they can't pay it off, if they're in big trouble, if the financial statements get worsening year after year, if the company reports don't look good, if the outlook that they put on the bottom of the company reports is not good for the next few years, that's the time you look at that and think, should I sell that and deploy my money elsewhere? The stock price dropping on its own is not a valid reason to sell the stock. And in fact, more often than not, if it's a stock you've done the really good research on and you've done all your homework, it's actually usually a buying opportunity. It just means that if you've done all that research, then, and at the time you bought the stock, you saw it as good value, surely if the stock's down 10, 15, 5, 20%, that's an even better buying opportunity, so you should be topping up. Now, again, this is not investment advice, do your own research, but that's the way I work it. So I have all my stocks, about 20 or so, 25, and what I'll do is when we get a drop in the stock market like this, I'll deploy some cash into the ones that I'm not overweight in and that I want to have more exposure to their dividends and the payments that come in. What I tend to look for when I'm deploying cash is the stocks that I'm not too overweight in, the ones I've already done all the research on. I'm still happy with the company. I'm planning on holding them for a long time, 10 years plus. I tend to hold a lot of my stocks for, unless there's something majorly wrong with them. And it has to be something majorly wrong with them. A drop in the share price is not a valid reason to be selling. It's more of a valid reason to be buying than selling. And Peter Lynch, I think it was Peter Lynch, he famously said, I don't know the exact words, that you're not a proper investor unless you see a 20% drop as a buying opportunity, not a selling opportunity. I'm not sure if that's the exact word. So if I can find it, if I can find a screenshot of his quote, I'll put it up here. But essentially that's it. You increase your holdings on those really good stocks that you're committed to, that have got a good track record of paying dividends, a track record of coming out the end of drops like this in the stock market, and you just increase those holdings. You know, you've already done the research. So when you did the research and you bought them and they were 10% higher than they are now, surely now's the time to buy some more. And that's how I've grown my portfolio over the last 20-year period. If you're liking this video and you're finding it entertaining and the information useful, please like and subscribe. It helps me decide whether I want to carry on doing this and whether there's any interest in it. My emphasis is on dividend paying stocks. I love to see those dividends coming in every month. It's just like an extra salary coming in for not actually doing anything. Well, apart from doing that initial research in the beginning, it's just nice to see all that come back in. And all I do is just reinvest that straight back into the stocks that paid me them, which just snowballs and grows those dividend payments, grows my holding, and hopefully you get some capital appreciation with that as well. As a result, I'm hitting payments of £1,000 plus per month. Some months are a little bit less, some months are more. And in January, between my SIP and my ISA, I hit over £1,500 in passive dividend income, all reinvested straight back into the stocks that paid them to me. And if you want to see the stocks that paid me those, how much they paid me and how much I expect them to pay me for the whole of 2025, check this video out next.